Now that we've identified a trading signal we would like to trade, the next step is to place a trade based on that signal. To do this, we'll use a place trade rule. There are two rules that can place trades. One for placing single trades and managing the risk, and another for placing multiple trades simultaneously, which we'll explore in a later video. For now, let's use the basic place trade with risk rule. First, we select the broker and symbol we want to place the trade with. In this case, we'll continue with gold against the US dollar, trading on the same broker account used earlier. The platform supports multiple symbols and multiple brokers in the same strategy, so this rule could place trades for a different symbol than the symbol used in a price data rule. This capability supports pairs trading or arbitrage strategies. Next, we configure the side of the trade, either buy or sell. Then we choose the order type. The platform supports the standard execution types: market orders for immediate execution, limit orders to set a target entry price, stop orders to enter on a breakout, stop limit to mitigate entry slippage risk. We also support a custom limit stop order type, which places a stop order behind the spot price when price is moving fast in one direction and is useful for trading reversals. We can also set risk management controls in the place trade with risk rule. If enabled, risk management allows you to configure a stop loss as soon as the order is filled, ensuring protection from the outset. You can configure risk using a fixed amount in either the trade-based currency or the strategy's default currency, a number of pips from the entry price, or a specific target stop-loss price. For example, let's say we wanted to risk $100 on this trade, with a stop distance of 500 pips. It is important to take note that all amounts and pips entered that would result in a trading loss for a position are entered as negative numbers. This reflects that they're measured relative to the trade entry in the opposite direction. With risk defined, the rule calculates the trade size dynamically, based on broker constraints and your configured limits. To maintain control over position sizing, you can set a maximum quantity for a trade. Even if the calculated quantity exceeds this limit, the rule will cap the trade at this maximum. You can choose to override the maximum quantity limit for any one trade using the checkbox here. The maximum quantity will be used for a single trade, but this override instructs the rule to place additional trades to meet the calculated position size required while respecting the maximum per order. For instance, based on a risk amount of $100 and risk pips of 500, you would be placing a 0.02 lot position. The maximum quantity is set to 0.01 lot per order. Therefore, two separate 0.01 lot orders would be placed. Next, we have advanced options to handle any issues placing the order. The retry timeout checkbox determines how long the rule will continue to try and place the order if a rejection is received from the broker. If no response was received from the broker, then the rule will check whether the order was placed with your broker before retrying. The close on cancel checkbox instructs the rule on how to handle race conditions for an order. In fast-moving markets, a cancel order instruction may be sent to the broker at the same time the order is filled by the broker. If this happens, the rule can be configured to automatically send a close position instruction immediately. And that covers all the major features of the place trade with risk rule. All that is left is to set the rule to execute after the 3 green candles logic rule.